Okay, Tyler, big oil is at it again. Tyler, what's happened?
After a $60 billion acquisition just a couple of weeks ago, ExxonMobil buying Pioneer Natural Resources, Chevron decided to make a big splash too. They are acquiring Hess, another independent oil and gas company, for $56 billion in an all-stock deal.
All right, we're going to have a conversation about this deal, whether or not we think Chevron is a buy. But before we do that, I'm Jason Hall. This is The Smattering. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, please go to our special link, fool.com/The Smattering. Motley Fool's got its 10 best stocks to buy right now for you. Be sure to check out that link after the video. Okay, Tyler, give us the details. Like you said, ExxonMobil is lined up this deal for Pioneer Natural Resources. We first started hearing about that last spring. That deal has been agreed. It's got to go through all the typical regulatory and shareholder approvals, but it's about a $60 billion deal, stock-based deal. What's Chevron buying Hess? How's it paying and how much is it paying?
Like you said, with Exxon, it's an all-stock deal. So exact same thing. Chevron is doing an all-stock deal for Hess for $56 billion. Same kind of deal, like you said, with Exxon. Of course, it has to go through all the shareholders, it has to go through all the regulatory approvals, but I think there's a reasonable expectation that these things are going to get done. There's been a lot of writings and musings, people that follow the oil industry a lot lately, and have been saying that consolidation is coming and that it's a important shift in what we're seeing in oil right now, because the need for the independent oil and gas companies, the ones that aren't the big ones going out to do the big expensive projects that take decades, they're the ones that developed shale and turned it into this game-changing aspect of the oil patch. They've done it. They've proved that it worked, and they've wrung out some costs. But if there's one thing that integrateds know how to do, they know how to wring out costs better. And so that is part of the thesis on why ExxonMobil is buying Pioneer, and I would say maybe about half of the reason that Chevron is buying Hess, because Hess is a shale operator, but also has extensive offshore. And that is actually the key and the thing that you're going to read a lot about with this deal specifically.
We did a prior video looking at the ExxonMobil deal, so I encourage people to go check that out. And what we talked about with that one largely is that ExxonMobil has already established a pretty big presence in the Permian Basin, and the Pioneer assets are very adjacent to where it already operates. So there should be immediate benefits in terms of operating leverage and efficiency, like wringing out costs like you were talking about. Chevron is a big offshore operator in different parts of the world, but you don't really get a lot of the same adjacency benefits when you're talking about offshore generally, and especially with the Hess assets that are part of this deal, right?
Yeah, and that's what makes it so interesting, because basically Chevron is buying into ExxonMobil's crown jewel, which is the offshore blocks in Guyana. About, I want to say 6 or 7 years ago, I believe, ExxonMobil discovered what's called the Starbrook block offshore Guyana, and it has turned out to be one of the most prolific and lucrative offshore oil finds of this century. It seems every single quarterly update that we've seen from Chevron since then, or Exxon, excuse me, since then has been, hey, look, we found more oil. This thing's really productive. As of right now, they expect that it's an 11 billion barrel resource, and the development costs of it are somewhere below, right around $25 per barrel. So in terms of offshore production, this thing is huge. It is extremely cost effective, and ExxonMobil has plans already to ramp up to go from, I think, what's like a 500,000 right now to well over 1.5 million barrels per day across the entire field. And so Hess had a 30% share in this. They were the non-operating partner alongside of ExxonMobil, along with one of the Chinese ones. I think it was CNOOC was also a partner in this. But Chevron basically looked at this and said, we can go into this and basically benefit just as much or as Exxon is by acquiring Hess. And surprising that Hess was able to do that versus ExxonMobil, considering ExxonMobil is a partner with them in this. But and if you consider the price paid, like I said, $56 billion, but it wasn't a huge premium to what Hess was trading for at the moment. And we've talked about, is oil companies cheap right now? Maybe, I don't know. But to get access to this, which in my opinion is one of the biggest kind of coups for Chevron in a while, in large part for me at least, because one of the knocks I have had against Chevron for a couple years now is all of their development and growth for production was almost exclusively tied to shale. They had one large production asset that they were going to develop in Kazakhstan called Tengiz. It was an existing facility that they were going to basically improve production rates at. But aside from that, it was all shale all the time. They didn't have a lot of like offshore blocks that they had on the market or things that they were developing. You hadn't heard a lot of news on that end. So to basically tuck in and be ExxonMobil's new dance partner on this block is game changing for them, at least I think strategically. How much it changes the overall thesis of Chevron, I'm not 100% sure. It's still a very exploration production heavy integrated oil major, has a nice upside now with that and some long tail benefits of longer tail cash flows from offshore. But it's hard to not look at this and say, if Hess was on the table, why didn't ExxonMobil go after that instead?
I think they both solved interesting needs for both companies. One thing I want to talk about that I think is notable here is it's pretty easy as an outsider to see these headlines and think, oh man, we're at the top here. We're seeing these big oil companies, they're throwing their money around. And the reality is Chevron and ExxonMobil do have incredibly strong balance sheets right now. They've generated enormous amounts of cash flows in recent years. Even after share buybacks and dividends, they still have a lot of cash sloshing around, but they're not spending the cash. I think that's the interesting thing about both of these deals is you see wherever you think about the valuation of the oil and gas market, we've talked about this before, you've pointed out that the integrated majors, the US integrated majors they're not cheap right now. Maybe even a little bit expensive, I think is reasonable.
Certainly compared to a lot of its peers, if you look like at the European majors or if you
Right.
look at some of the other ones offshore, they would have similar profiles. Yeah, ExxonMobil traded significant premiums to everyone else in the market right now. Hey, use that currency when you got it.
Exactly. They're leveraging their most valuable currency, in this case, their stock, to make these acquisitions. And I think that is a tip the hat to the management of ExxonMobil and here to Chevron for doing that exact same thing, retaining that cash, particularly knowing that if you're Hess, if you're Pioneer Natural Resources, if you're any independent, your cost of capital is going up, right? And being able to continue developing and expanding, especially Hess with these offshore assets. Now, again, they're a financial partner, not an operating partner. Again, those are the assets that take a lot of capital up front and years before you get a return on. And seeing the writing on the wall with rising interest rates. And all of that to say, if I'm Chevron's management, if I'm an investor right now and I'm looking at these companies, I would be pleased that they're using their share capital to make these acquisitions, retaining that cash to be able to focus on investing in opportunities, paying down debt as debt starts to mature instead of having to refinance at higher rates, being really mindful about managing that balance sheet. I think that's smart. So last question as we wrap things up here. I let the cat out of the bag when I said thinking about these stocks as being pricey right now. Thinking about Chevron as a stock to buy right now.
Like you said, if management is seeing and says our stock is good currency, that typically means that the stock is trading at a decent premium, right? And one of the worst times to invest in oil companies is when they're trading at a premium because they go through cycles. And we've seen a 7-year cycle. These companies were left to the dumpster of Wall Street for a while. And so to me, I would say new money, maybe not. If you're an existing shareholder, I think this is going to be probably a good deal for you in the long run. But if I'm going shopping for something new in the oil patch right now, I'm probably looking somewhere else.